Most people think raising capital is this impossible feat or that there's some element of luck involved. Well, I could not disagree more. And in this video, I'll be showing you the easiest way to raise institutional capital for absolutely any business. I'll be showing you the method we developed after dozens and dozens of successful raises in the last few years, which has allowed the businesses that we've worked with to successfully get the funding as easily as possible, just like the one you're seeing on screen right now. For example, New State Capital Partners Fund 2 closed a $255 million raise, or take Skyview Ventures, who secured $200 million for their mid-market strategy. Now, these are kinds of outcomes our method consistently delivers. What is this new, easiest method? The easiest way to raise capital is to use a structured, investor-first fundraising process, one we've refined after billions in closed commitments. Now, most founders try to pitch everyone they could find, rely on luck, spray and pray with their decks, and that's exhausting and inefficient, and oftentimes leads to failure and blowing the raise entirely. So you're probably asking, well, what are my chances to complete a successful raise myself? That's why you're here. While there isn't one global figure, conversion varies a ton by type of raise, track record, whether you have warm access, directional benchmarks founders and managers use. Venture equity, seed to Series A, cold to closed, is about 0.5 to 2% of outreach investors end up wiring. Now, warm intros with solid traction, you're talking about 10 to maybe 25% of targeted firms progress to term sheet if you're lucky. And then of those, about 30 to 70 of signed term sheets actually close. Now, first-time VC, PE funds raising from LPs, first close probability is about 5 to 15% roughly for true first-timers. Re-ups, spin-outs with prior DPI, about 40 to 70%. Real estate, programmatic JV / investor club with institutions, no prior institutional JVs, less than 10% close, and an established sponsor with cycle-tested track plus co-investment rights, about 20 to 50% close across a very tight list of the right fit LPs. Project finance / infrastructure from serious IOIs and LOIs, about 10 to 30% make it to financial close, technical, permitting, and offtake drive attention. Corporate and strategic, CVC, OEMs from qualified pipelines, about 10 to 25% of those close. Integration and BD alignment is the gating factor there. So why this mythic 5%? If you average across cold outreach, first timers, and mixed categories, many funnels do net near 5, maybe 10% from credible first meetings to actual money in. So that's a reasonable back of napkin for newcomers. Now, for experienced teams with warm LP and GP relationships, such as our firm, the weighted average often lands north of 30%. So here's how to push your odds above the baseline. We call them fast levers. Narrow the why us, why now, why you to a one-liner plus 3 irrefutable proof points: real traction, realized DPI and track record, signed offtake, unit economics. Only pitch true right fit institutions. Mandate, ticket size, geography, stage. A 40-name sniper list beats a 400-name spray list every day of the week. Lead with investor tax structure advantages. For example, QSBS, depreciation, co-invest rights, preferred waterfall clarity. This consistently boosts engage and term sheet conversions in our community. Try it for yourself. De-risk escalation, anchor LOI, hedging, EPC, or problematic pipeline, and show exact use of proceeds to value inflection. Shorten diligence, meaning data room ready on day 0, third-party QOE, customers available, etc. And our method really flips the script. For our exclusive clients, we build a pre-structured pipeline of the exact institutional investors who are most likely to say yes to your project. We prepare storylines that resonate with them and compress the timeline. The result? Faster raises, fewer wasted meetings, and obviously more money committed with much less effort. And just to give you a sense, we've helped funds like Windrose Health Investors close a $705 million raise, and Samuru Equity Partners closed $720 million in growth equity. Now, these weren't dragged out 2-year battles. These were streamlined, focused processes. So why does this work? Why does this work when traditional fundraising doesn't. First, most businesses and funds approach investors too early, too broadly, or even messy positioning. Even if they have a great product or track record, their process absolutely kills them. Now, second, traditional methods are reactive. You pitch anyone who will listen and hope someone bites, right? Sound familiar? But institutional investors are overwhelmed. They don't have time for that. They see hundreds and hundreds of deals every week. If you don't show up with the right structure, story, timing, you'll get brushed off, maybe even for good, and your deal's done forever. Our method is superior because it is proactive and precise. We already know which LPs are right for you. We know the hooks that make them take a meeting, kick that door down to say, yes, I want to know more. And we remove uncertainty and unnecessary friction. And third, timing matters. Right now, there is more capital chasing specialized strategy and mission-aligned platforms than ever before. Look at Avance Investment Partners, a Latino-led lower middle market fund that raised $1 billion by leaning into a unique positioning. This would have been much harder 10 years ago, but today it's the right time with the right story to win. So here's the exact step-by-step process for raising capital the easy way. And step number one, investor mapping. Most businesses waste time pitching the wrong investors. Yes, I've said this countless times over the years, and I guess I have to just keep repeating it until you guys get it. But I've seen mid-market companies chase billion-dollar funds when they only need 20 million. That's a dead end. But the easy way? Build a curated list of funds that fit your exact stage, sector, and check size. If you just do this one step right, you'll cut your fundraising timeline in half, maybe even more. Now, step number two, build the storylines. I can't say this enough. Institutions, they don't buy products, they buy stories. If your pitch is a pile of numbers, you're forgettable. For example, one client we worked with, their deck was filled with charts and buzzwords, but there was no why now, why us. We reframed it into a story about how shifting demographics created a once-in-a-generation opportunity for them and the investor. And that single narrative shift unlocked $100 million in commitments. Now, your job is to make investors feel they'll miss the window if they don't join you. Step three, clean material creation. So here's where founders usually overcomplicate things. You don't need a 50-page slide deck. Literally this afternoon, someone sent us a 54-page deck looking for 50 million. You don't need that. You don't need 10 appendices. You need your foot in the door with the right investors. A one-page teaser that gets meetings. A 7 to 12-page slide deck that tells your story succinctly and crisp in the format that we preach here on the channel religiously. And you're going to need a data room with key financials and governance. That's it. Anything more wastes time. Now, step four, pipeline management. This is where most raises fall apart. Founders pitch 10 investors, then lose track of who's warm, who's asking for the deck, who's passed, and who's waiting on a reply. We run it like a sales pipeline. Every investor has a stage, contacted, intro, due diligence, term sheet, and every week we push them forward one step closer to that end goal. That system keeps momentum alive, and it's why our raises close more frequently and much faster than industry standard. Now, step five, leverage early anchors. This is one of the biggest shortcuts. Instead of trying to close 10 investors at once after you spray and pray, focus on landing one strong anchor investor early. Why? Because anchor investors create social proof. If one respected LP commits 20 million, guarantee the others are going to follow. This is what you want. Create that momentum. Think of it like the well-known saying, pioneers get scalped, settlers get the land. You've probably heard this if you tried to pitch any VC. It's startup slang, meaning first movers take the bruises, fast followers often capture the market. In one of our raises, we secured a single anchor first, and that commitment snowballed into a $200 million raise within 60 days. So step six, time the market. I know what you're going to say, but this is different. Here's a mistake I see all the time. Companies raise when they're desperate. Investors can smell that from a mile away. The easy way is to raise when you still have 12 months of runway and when the market cycle favors your sector. Think of it like going in for a bank loan. They'll never loan you money when you need it. They'll only loan you money when you don't need it. For example, we helped a healthcare platform align their raise with an LP re-up cycle. That timing alone shaved off 6 months of the entire process. Now, step seven, close efficiently. The final step is to keep your structure simple. Founders often want to get creative. multiple share classes, complicated waterfalls, earnouts. Keep it simple. Institutional capital hates this. The easiest way to close is with clean, straightforward preferred equity. It signals professionalism and speeds negotiations. If you just follow this process I just laid out, you'll raise faster with less stress and with the right investors on your side. So, quick side note, a lot of founders get stuck right at step one, building their investor pipeline. That's why I put together a free tool called the Investor Pipeline Builder. It shows you exactly how to identify and organize the right investors for your raise without wasting months of pitching the wrong people. It's free. Just click the link below in the description and grab it right now. Let me show you two examples. First, Trive Capital, a high friction operational intensive PE fund. We help them design an LP segmentation and timing strategy, and the result, a $1.2 billion close, faster than industry average. Now, second, New State Capital Partners, a smaller $255 million lower mid-market raise. We crafted the GP pitch and LP deck and positioned them perfectly for institutional money. They closed cleanly with the right investors on board, which is the whole point. But different sizes, different sectors, however, the same method, streamlined, precise, easy. The easiest way to raise is to map the right investors, tell the right story, and move through a structured process that eliminates wasted time and friction. If you just do those three things, you'll raise capital faster with less stress and with the right long-term partners. And if you're serious about this, click right here to go to the next video where I show you exactly how to execute your seed round and get ahead of 99% of other people. Now, this could be a complete game changer for you, so I will see you over there.